Hey guys, welcome to the weekly overview session. I'm TinTinTrading, and today is 5th of September 2022, week 34 of 2022. We're boom traders, and in this video, we're gonna go over the weekly market action that we've seen last week and our judgment of how the stock market is doing. The agenda for today is a bit longer than previous videos. We're gonna start off with reviewing the models that we follow. From then on, we're going to look at the general price action. We're going to look under the hood at the internals, the sentiment, the seasonality, and we're going to finish off with a macro picture and a summary. Now, it is a bit changed from other weeks, but hopefully we're not going to run into more than 20 minutes, so you can very quickly review this and get a general pulse of how we are assessing the market is doing. So starting off with the models, we have changed the way the models look. From now on, we want to show you this kind of hierarchy. We're going to start off with the market model. Generally, this is reviewing the market indexes and seeing how they participate based on whether they have bullish or bearish action and whether they're volatile or quiet. An appendix of this model is right at the end, and we're going to look at it at the end of the video. From then on, we're going to look at the trading environment to see generally how the stocks that we typically trade are doing. This is separated in 3 stages: hard penny environment, caution, and easy dollar environment. And finally, we're going to come with the most precise model, which is the risk model. This kind of is the final filter for which we see whether to aggressively jump into the stock market or not. Currently, there are 4 signals here: sell, get ready for sell, buy, get ready for buy, and buy. And on top of that, all of this, we take all this into consideration and just look at the positions that we're about to open, the stocks, are they setting up or not, and whether they're coming off good basis or not. So starting off with the first model, this is the market environment model. As you see, it's on our outright sell signal, 0 out of 4. Just show you this, 0 out of 4. We can also, from time, we're going to be showing this separation within time frames. We have the short term 2 out of 10, 2 out of 10 for the midterm, and about 6 out of 10 for the long term. The trading environment, or how breakouts are performing, again, is 0 out of 3, because we assess this as the hard penny environment. And finally, the risk model is on our outright sell signal, 0 out of 4. So we do not see any reason for us to get aggressive and to be overly exposed within the market. Market price action. This shows the Nasdaq Composite. As you see on top, I have the relative strength lines, new highs, new lows are here, and the price action with a custom volume indicator on the bottom. As you see, after the follow-through day in June, we've been getting a bunch of these cyan signals, which indicate positive technical market action. These are all based on a methodology from IMDb, which is from their market school lessons and other courses that they've been doing throughout the years. And what we usually want to see is a bunch of these and a little bit of these pink lines, pink arrows. And that's exactly what we saw. Hence why we got quite positive on this leg up. Of course, the 200-day was the logical resistance. And our assessment was that if this is the beginning of a new bull market that's about to be strong, we will actually kiss it, touch it, to get close to it. We did so on the SPX and hold the level, but consolidate just underneath it. Unfortunately, as you see, I've drawn this black trend line. We broke that quite decisively. And from then on, we've been getting a lot of these technical sell signals with not so many big cyan arrows. Usually, if you also follow breakout methodology, first 1 to 4 weeks is quite important post breakout, and it's very important not to violate the follow through day low. And from then on, the 5 to 13 weeks is also the second milestone that needs to be covered before we set bull rally jump from here. Now, one thing that's important is also to look at the angle of the 200-day moving average. This is this black line. As you can see, you can just look at the moving averages here based on color, and the 200-day is steep downward sloping, which is not great. And that's what we wanted to see. By consolidating just underneath it, it usually will flatten out and get ready to move up, but this is not the case. Additionally, another worrisome sign is the volume. We're getting actually all those selling that's been coming down here underneath the trend line has been all increased volume, aka a bunch of distribution days. These are some of the technical signals. So Eureka Trust, if you don't know about it, we'll cover it in another video or in a lesson. But we got two Eureka Trust and we got a power trend turned on here only to see it turned off here. So pretty much most of the advancements that we did, we gave back. We gave back a lot of ground, and hence why we are very cautious at the moment. Now, if we open and look underneath for the internals, one thing that we look at is the up versus down volume and the down versus up volume. If you've seen other videos, that this is very important signal to determine breadth and volume trust. What we had on the way down here was quite normal for a bear market. And this was a decreasing bear thrust on the rallies up, coming lower and lower. And we ended up with this massive down versus up volume, which was, I don't know, 80 or so here, right around the bottom. And this brought down to capitulation actions. And I said that at that time, that if this is a great time actually, because usually bear markets bottom on capitulating action. And from then on, we wanted to see a rally up with some constructive volume patterns. And that's exactly what we saw. We saw a bunch of blue skyscrapers coming up on the volume up, while the volume down against up is going down. Now, unfortunately, with this rally down now, with this decline, we're seeing the opposite action. As you see, we're getting these, which are a bit worrisome, these skyscrapers above 10, which are not great. And at the same time, we cannot get a reading above 10 in the up versus down volume. So that's a bit worrisome. From then on, if we look at the internals, we are on the short-term overbought oversold oscillator. We are at levels where we did get a rally action, which is positive. However, the 10-day moving average up volume versus down volume has shifted. As you can see, down volume is more now than up on the moving average. And the same negative shift we've been seeing on the 10-day moving average, net highs against net lows. This is information from MarketSmith. Again, the net lows are pointing up and the net highs pointing down, both of which are negative action. So very mixed in this case. At the same time, we have sentiment, bull versus bears, and put versus call action. This is information from Investor Business Daily. The bulls currently are at 38.40. Usually this is both of these a contrarian indicator, meaning that the lower the bull number and the higher the bear number, the more bullish for the market. Now, as you see, we have a red line here upon 15, and that's the level historically that we've seen where we can say that a bunch of the traders out there are, quite a big bunch of traders out there are bearish. As you see, we did reach this level when we were getting the market low, but we're still quite far away from it here, similar to what we've been getting midway through the rally up. So that needs a bit of work. So if we say that this is what the traders do, are they buying puts or not? This is what the traders are saying, or the advisors are saying. Are they being more bullish or more bearish? And as you see, we did get this kind of shift here sometime, and it shows that the bulls are higher than the bears, which is the general opposite of what we want to see. Usually bullish numbers under 35 are very welcome in this kind of environment, and bearish numbers above 35 or 40 are really good. Our bottom here curve, while we were getting about 30, if I believe right, on the bullish, and about 45 on the bearish. So again, sentiment doesn't look very good for the long side case, since we're not getting big sentiment on the advisory side, and also we're not seeing a bunch of action. So that opens a door for more downside potentially. In terms of seasonality, here is the Emmett Davis 4-year cycle research. We are entering the period of September, and this period before has been known as the worst for the stock market. Also, it is the one way we can see a lot downward pressure from seasonal point of view. So again, another flag to be cautious. Now, when we talk about seasonality, we've been proponents of two previous bear markets as some sort of a template how we can turn out currently, and these are the 1990 and the 1970s. So in terms of the 1990, I've pinned out this a few charts for you to show you two things. First off, we did get this kind of volatile action, and then we got 3 legs down, 1, 2, 3, as we got. Currently, we did get a rally up, but as you see, midway through the rally here, we actually moved and start moving down in similar fashion to what we are doing now. And we've referred to this in previous videos as carving out bottom. Basically, bottoming is a process, and it's not straight up, straight down, but it could be straight down, up, a bit of sideways digestion, maybe a bit down, more sideways maybe, and up. This period here I refer to as a lockout rally. As you see, there's pretty much no consolidation going straight up day after day. And then the previous high here acted as a consolidation area. So that's one precedent. Again, you can see that the 200-day moving average is pointing downwards while we're carving out this bottom. So this is one potential scenario. We might be going down, but pretty soon, if this is the case, we want to see some consolidating action. Now, what's important here in the 1990, this is the weekly graph of weekly chart of the same period that I just showed you, is I wanted to show you when the leaders were breaking out. So we did have a bunch of follow-through days, failed in these cases. And after those follow-through days, we get the final follow-through. Now, what's important, and the point of this picture, and you can screenshot it, is when did the leaders of the next bull rally break out? And as you see, all of these leaders were breaking out prior to us getting the follow-through day, and definitely prior to the lockout rally that I showed you. So this is one of the big reasons why we are currently very active and looking at how the stocks are moving out, how the stocks are breaking, holding, and we're looking for those true market leaders. Basically, that's what we want to see them, because they're not going to, even if they break out and we make 50 to a 20, 50, 30, doesn't matter, 100%. This is, in those cases, has been the beginning of a few 1,000% move up. So we want to identify them. We want to know who they are, and we want to get into them. Currently, we have a few names contestants, and we discussed those in the Discord room. However, they seem a bit more overcrowded. Anyhow, going back to the weekly, and as you can see, here is the 1970s precedent. The bear market, we get 3 legs down. Again, quite normal for a bear market. The rate of decline, as you see, changes. You can see that by the angle of the arrow. And from then on, we start moving up, but in some sort of consolidating fashion. We go up, we go down, then we have this consolidation. Then we go up again. We stay more sideways, and that's what we wanted to see, more sideways action under the 200-day, and from then on a lockout rally near the previous highs where we got a few more corrections down. But again, this process is carving out the bottom of the bear market. So that's what we're looking at the moment and assessing whether the carving out is healthy or whether we're in a situation where we might actually be somewhere here and that we have another big leg down to anticipate. Now, again, in the 1970s, here is when the big true market leaders were breaking out. In this case, it was quite consequential as the bottoming of the general indexes. But as you see, the true market leaders are not expecting a massive rally up, and they sometimes work against the market. And this is a great characteristics, because by evaluating their relative strength and the relative strength of stocks, currently, they really stick out as a sort because they outperform it while the market is going down. They're currently going up. So their relative strength is a big signal that starts flashing. So only there if you want to see it. Now, you have seen also historically, this is a study of the times when we've been getting over 15% declines in a quarter. And as you see, we do have some sort of historical bullish sentiment. In this case, we'll see if this plays out, or it's going to be another outlier for the next quarter change. Finally, we are going to look at the macro picture. First, we're going to do our inflation probe. As you see, the general commodities and some other indexes that we look at are still looking fine when we talk about battling inflation. Copper down, oil is still under the 50, the red line was the 50-day moving average. Lumber and the energy is now picking up, but again going down, while inventories have been skyrocketing for this year. And we see that the used cars are going sideways, which is not great. We wanted this to go down, but this, in essence, is showing some relief of the pressure of inflation, which is again something that the Fed is looking at. Now, talking about the Fed, of course, big reason for this decline was the Jackson poll and the uses of the words forceful and until results come by Chairman Powell. And the whole idea is that, in my opinion, the Fed are really fearful not to get themselves into this type of situation. Here we have a graph of the SPX, the Fed funds rate, and the inflation. And the whole idea was that last time in the 70s when inflation was skyrocketing, as you can see here, it really took the Fed to engineer two bear markets indicated by the red areas in order to battle inflation. First, they bumped up the Fed funds rate, but they took their foot off the gas, decreased inflation, but they didn't kill it. And that came soaring back up within the number of years, which again required engineering of another recession. And hence, this is, in my opinion, the reason why they're fearful. Now, if you look at some data, again, we see some conflicting evidence. Here we have the DGAI versus the real monetary, fiscal, and exchange rate policy index. From then on, we have the NDR index, and we have the 12-month change in this policy index. Now, the study from NDR, you can pause the video, read it carefully, but it looks at the times when this blue line is above 8, between -8 and -8 and 9.3, and below -9.3. And what are the next 1 year forward returns? Currently, we're at -51.5 percentage points. And we see that it's highlighted here in gray that we're seeing the weakest period of 3 bunches as a forward-looking annual gain. So this is one bearish study that we saw. But then the conflicting side is this PX index versus the 10-year Treasury yield minus the effective Fed funds rate. The reading here that we're getting is 0.6 right up here. And again, when we see what does this mean in terms of the studies from NDR, every time that we've been above 0.2, we're getting 10.21. Does this mean that we're consolidating those sideways? I have no idea, but these are some of the data points that we see. And as we see, our job as traders is not to predict, but to try and look at the most probable outcomes and play out those, again, with following stocks as the main leading indicator. Now, currently, we see a bunch of studies and our research shows that there are conflicting evidence, henceforth, and the models, all models are negative, henceforth, why we are staying away from getting aggressively long in this bottom. So in essence, if I have to summarize it, we've had this downtrend with the increasing acceleration of decline. We got a follow through day. We did get a rally, and now we are moving down. We're somewhere here. We're at the point whereby we need to see some sort of traction or where the rubber meets the road. You've probably heard that. I've seen that on Twitter many times. And one of two scenarios can happen. Of course, we can either have, or we can anticipate a lockout rally, or we can anticipate capitulation action. My personal guess and what I think we might need, given the seasonality, is some more sideways action before the lockout rally. I do believe that we've been seeing the lows in this bear market, but I might be wrong, and it really depends on a lot of external factors as well. But this is where we have to monitor very carefully what's been happening. Again, remember, the whole idea about being active in the market is to try to find those true market leaders, because that's our point here, not to estimate if we're wrong or right. Finally, summary. All models are showing sell signals. Apart from the long-term trend model, our levels on the general stock market are not holding. We broke out the 50-day. We're on the declining 200-day. We've been getting a lot of the technical signals turned off, and new negative signals are printing. The market action is showing distribution, a bunch of distribution days, and we have negative seasonality while the macro picture looks, aka caution until environment improves. Personally, I have less than 5% exposure on the market within 3 names, potential market leaders. You can come on Discord and check those out. I print those every day with their respective P&L. And I'm looking for stocks to set up, because Even though we didn't speak about this here, but stocks are the main indicator and my trading results are the main indicator of what I do. But here I want to see if there's wind in my bag or it's against my sales. Now, as I promised at the beginning of the video, here were some of the models. This is the general market model. As you see, we have a matrix that separates bullish to super bearish versus volatile and quiet. Here is a hard parity environment. Well, while here is the easy dollar environment, we have the long-term trend model, which is currently on positive on a buy signal, even though I advise not to go more than 50% on the long term yet. We have the risk model and its components on an outright sell signal, while most components are negative. And we have the tactical trading environment, which is on hard penny. So that's it. Hope it was useful and see you in the Discord room.